evening, Penny. I just saw your message. Thank you. And let me just start up the page. Let me know once you see it. All right, are you able to see the screen? I hope so. And along the way, feel free to put up your chat and let me know what you're thinking or what you're wanting to ask. And definitely, I will make sure that we spend some time on the question later on. Before we begin, as usual, just a quick disclaimer. All this webinar that I'm doing for you guys are my own work, and most of them is based on my own research and my own opinion. And I do work for iFast Global Market, so please note that whatever information I'm sharing today is purely my own personal capacity and doesn't represent the view of the company or my colleague in any way, right? And so, welcome. If today you are joining me for the first time, I welcome you, and you can check more information on some of the webinars that I've been doing or from my website learnwithstanley.com, and you can sign up for the mailing list to see if I am hosting some of the webinars for you guys. And as usual, I talk about just now that I'm working with iFast Global Market. And if you have never heard of us, it's a wealth platform that allows you to gain access to all your financial needs. We have access to a wide selection of unit trusts, bonds, our in-house managed portfolio, of course, for your cash account as well. And we do provide some of the quite attractive cash account interest for many currencies, and also as a brokerage account for your stocks and ETF if you want to trade both local market and also foreign exchange. And iFast itself is a Singapore company listed in Singapore. And yes, Penny, iFast, we do have arrangement for PRS as well. And also, you can link your EPF directly to the platform as well. So when you invest in your EPF, you'll be able to see and view and change your portfolio from the iFast platform. Right? I'm going to talk a little bit about my own uh, services as the financial advisor. And one of the key things that I tend to do is, instead of focusing on so much on pushing specific products or funds to my clients, but rather I want to spend more time actually on understanding each of your situation through a software that I use, and coming up with a systematic financial planning plan for you and a process for you, and simulating out some of your financial goals or some of the risk scenario out there, and to make sure that we are able to protect and also plan for your future in a systematic and a less risky manner. And I myself has been investing in the market for 17, I think coming to 18 years so far. And I have done many mistakes, which I'm going to share with you guys today as well. But after going through so much, I have kind of formed some of my core philosophy when it comes to investing, which right now I really focus more on long-term opportunity in the market. And I really see the stock market as a way for us to grow our investment for a much longer period of time, instead of using it as a quick trading opportunity, right? So what I mean is, every time when someone asks me if I should be starting to invest, what's my time horizon? I would say that if you do not have at least a 5-year time horizon in the market, it is really not worth starting investing in the stock market, right? Be it through unit trust or ETF or stocks. I would say that having at least a 5 year time horizon would give you sufficient time to see some meaningful return from the market. But anything lesser than that, there's a lot of luck element into that process if we are talking about much shorter time. And I do it through what I deem as collection of quality, right? I feel that the main thing in the stock market is we have to try to manage our risk. And I focus a lot on high quality funds, high quality stocks that can stand the test of time, right? Rather than going for the highest risk, highest return opportunity out there. And one key thing is I try not to time the market and just being able to be more contrarian. There's this, for example, the last few weeks has been very volatile, but that doesn't stop me from continuing my plan of average cost investing over time. And because in the long term, what I'm trying to build is what I call everlasting portfolio, something that's scalable, something that we can start small, but even as we scale, the process and the strategy stays the same. That is something that has worked for me and something that I have fine-tuned over the last 17, 18 years and have seen significantly favorable results in my own portfolio and something that I try to uh, work with my clients to do as well. So is there something, you know, you are thinking about and something that you might want to learn more about and want to speak with me one-on-one? Definitely you can check me out at learnwithstanley.com or you can WhatsApp me at my number and we can definitely set a more one-on-one discussion that is more specifics to your need, right? So now let's go into the key topic for today. And the key topic for today, I'm going to talk about, I highlighted five key mistakes across the board of all the different mistakes that I have made in the market and I have seen other people make in market. And I group them into five key areas. And from there, let's look at what is the issue from that mistake and how we can find ways to overcome it, find ways to identify it when it happens to us, and push ourselves back into the right path. Okay, I'll split it up into a few sections. First section is talking about the master of Warren Buffett. Then second one is a little story about me starting out as a value investor. Third is we're going to talk about a third partner of Warren Buffett and what happened to him. And then last, we'll talk about Katie Woods and ARK Invest and what we can learn from that. So the first one, I'm going to break it down into maybe a mini story. And from there, we'll learn a little bit about the situation and the mistake that we can learn from it. So the first one comes from the story of Benjamin Graham. So Benjamin Graham was the mentor and a key person that shaped the investment philosophy of Warren Buffett himself. And he is actually a fund manager and a lecturer in Columbia Business School. So he has started being a fund manager at a very, very young age. And by the time he was age 20, he was already earning $500,000 a year from the stock market. But he basically lost everything during the market crash of 1929, which led to the Great Depression for the next 10, 12, 13 years of the stock market, where it didn't move anywhere. So he went through that period, and that really shaped him and scarred him for life. And so from there, his experience, he started to write a book called The Intelligent Investor, still considered the most must-read investing book of all time, and also a more dry book called Security Investor. You can see there's a textbook. He used one of his textbook when he was teaching in Columbia Business School. So from these two books, he talked about a lot about finding very, very cheap and undervalued stocks. Cheap and undervalued stocks. Sorry for that. meaning that uh, his whole strategy is talking about how in the market we should find stocks that are so cheap, regardless of the merit of their business, that we can find such a cheap stock that when we are buying it, we are buying a bargain, right? It's almost like going into the pasar malam, going to night market and finding bargains, right? You don't care so much about the quality of the things, but make sure you catch a bargain, and that has been his strategy for most part of it after 1929. And he has done very well. He has done very well that his performance actually through his lifetime, he averaged around 20% a year compared to what the market did during that same period up to 1956 where he retired. But the market did about 12% a year and he and his fund did 20% a year. Very impressive. And Buffett worked for him for quite a period of time. There's a fun fact that Buffett actually wanted to work for him for free, and he rejected Buffett in the first place at first because Benjamin Graham was Jewish, and at that time there was a lot of prejudice against the Jewish people, and so he made it a point that his firm will only hire Jewish analysts and fund managers. So Buffett was not, and that's why he didn't hire Buffett in the first place. But after a while, he relented and he hired Buffett, which hired worked for him for a long time until he retired, and then Buffett started his own partnership. So he did very well. But the interesting thing is when you dig a little deeper into his story, is that when you look at all his great investment, you realize that his greatest investment come from this company called Geico. Right, in 1948, Ben Grams invested about 700,000 into this company called Geico. It's an insurance company, and he bought actually half of the company for $700,000. And when he bought into the company, he basically kept it. And Geico was a great business. It's an insurance company in an era where insurance company is booming and growing very rapidly. And this company ends up being one of the favorite investment for Buffett as well. So the story goes that after he retires, he was actually forced by the SEC to distribute out the investment to all the remaining investors. So all the remaining investors get shares in Geico individually. And for those that kept on to the shares, by 1972, Geico, that stock, the collection of stock, the 700,000 worth of stocks, is now worth 400 million, up 526 times. And if you do it in a percentage term, it means that this stock actually grew 30% a year, 30% a year for 24 years. So interestingly, for someone who is very focused on valuation, right? Only buying things that cheap and then selling it when it's expensive. Turns out his best investment is a company that he bought because it is a great business, and for investors who have kept it, and that business continued to grow until Buffett bought the majority of the company in 1995. So today, Geico is a wholly owned subsidiary of Berkshire Hathaway, the holding company of Buffett. But Buffett started to take over it in 1995, about half of it. And when Buffett bought it, that same 700,000 worth of shares is valued at $2.3 billion. So up about 3,230 times. And even after such a long time, about close to 40 years, 50 years, right? Almost 50 years, it is a company that still compounds at 19% a year for close to half a century, because it is such a great business that's still growing. Even until today, it's still growing. So the main interesting fact and interesting uh, conclusion here is that although value investors or investing, we talk a lot about finding stocks that is undervalued, finding stocks that is of a discount, but in actual fact, that is just one part of investing. And in fact, the more important part is actually finding high quality businesses, high quality stocks, high quality funds that will continue to do well for a very, very long period of time. So that's the first mistake I see when it comes to a lot of investors when they are investing. They focus too much on the price of that fund, of that stock, but not so much on the quality. Where in fact we should be thinking on the flip side. Yes, price is important, but the more important part to discuss and the more important part to factor in is actually quality. Now let's look on to number two. Number two is trying to time the market and trading too much in and out. This is something that I did way back when I first getting started. What I'll do is this is more like a screenshot of a newspaper. So when I was first started out in 2005, 2006, I'm still finding companies from the newspaper. So every day I'll flip to the finance section of the newspaper. And what I'll do is I'll look through what we call the 52-week low list. So the newspaper typically have a few tables and they have one side is called 52-week low. So these are stocks that are trading at their lowest point in the last 52 weeks. So for the last year. So my thinking was, okay, if I want to be a value investor, if I want to find cheap and high quality, um, low price stocks, I should be finding companies that is very cheap. So they should be trading very, very low. And my whole strategy was always searching around this company and then see if their business is still okay to invest in. And then I'll invest in them, and then hopefully they rebound a little bit. I'll sell. But more often than not, sometimes they will continue to go down, and because they are not very good businesses. And I found out by the hard way that a lot of time these companies are cheap for a reason. And I realized that sometimes cheap rubbish is still rubbish, right? But it also make me into a cycle where I have to constantly be trading. I have to find something and it goes up. If it recovers, I have to sell. I have to look again. If it doesn't recover, then I have to cut loss somewhere, or sometimes it's very, very hard to cut loss. But sooner or later, I realize that I make a mistake, and I will still have to uh, switch out again, and then find another company, right? And in a way, it's similar to trying to time the market, right? Thinking that just because I buy something, uh, it should go up, and I should be able to time it when it reached the peak, then I sell, and I assume I'm always buying at the bottom, right? So, in theory, our strategy will look something like this. If this is the index, right, or this is a stock, my idea is always to, oh, I should be able to spot it and I should sell here, I'll buy here, I'll sell here, I'll buy here, I'll sell here, I'll buy here, I'll sell here, I'll buy here. And I do it over and over and over again. And I make tons of money. But in actual fact, more or less, what happens is whenever that I sell or buy, it's never the bottom or never the peak. So I end up just randomly buying and selling all the time. So even if it's a stock that I buy, even if it went up 30% when I sell, it might not be the peak. It might still continue to go up, right? And the problem comes when if we do that over and over again, we never know when is the time that we we are making the right decision, and it because the market is constantly running, it is basically asking us to make a decision every single second, every single moment that the stock is ticking. So you go into an endless cycle that you're constantly needing to make a decision, right? Just on hindsight, it's quite easy to make the decision. But say for today, the market has recovered. Should we buy or should we sell now? Right? You can we can do a poll today, right? So with the market now recovered, uh, should we buy or should we sell? Like, put it down in the chat, and you realize that we will all have different views. We're all in different views, and most of the time, we will end up not being correct. And the moment that we go into the cycle that we should be trying to time the market, or we equate great results in the market to the number of action that we do in the market, that's when it will lead to more and more mistake, right? What I mean is we feel because from the way we say from our life experience and from our education system, we feel that the harder we work, the more reward we should get. That is the things that is ingrained in our mind. And so when we invest in the stock market, we have the same mentality as well. That the harder I work, the harder I trade, the more that I trade, I should get better results. When in fact, a lot of time that is actually more detrimental to our investment. Because the more we make, the more mistake that we'll end up making. And in investing, when we make more and more mistake, the gap between the market return and our own performance will widen further and further and further away. Right? It will be because every time we lost 50% of our funds, we have to make back 100% before we go back to the same level. Do you see that? So the effort to reach back is always harder than the downside. So in actual fact, in the stock market, we should be trying to minimize our mistake because in the long run, the stock market still goes up. It happens in all market, right? When you look at all the indices, if you stretch it out long enough, say 10 years or more, you'll realize that almost every single market tends to go up at different rate, sure. Right? This is the Hang Seng Index. Even when you look at it, it's still going up. Right? If you look at the US market, it's going up even more. If for the Malaysian market, for the Singapore market, they're all still going up generally. But it will not be a smooth ride. And the more we try to time it, the more mistake we make, the more our result will get worse and worse over time compared to the market. So when in fact, our thinking should be trying to minimize that. And the way to minimize that is we should not try to time the market, right? The person who try to time the market will do worse. Say this person who's trying to time the market all these points, compared to the person who just buy here and then wait until today, that person who just buy and hold it until today will still do better than the person who trying too much to time the market. Hope that makes sense. And this is again and again in a lot of my investment over the past 17 years is something that I have encountered. Right, and there are periods where I try to trade in and out, where there are stocks that I don't hold for a long time, and then there are stocks that I hold for a very long period of time without even looking at them. And I realize many of them actually do better. They wouldn't go up like straight away. Sometimes they go up and then they go down. After a few years, it didn't went anywhere. But the longer I wait, I realize that the more probability that I will end up profiting from from that trade on a buy and hold strategy compared to something that I buy and sell, buy and sell, buy and sell. So, for example, Netflix is a company that I started buying in around 2008, late 2008, 2019. It was late to the game, right? You can see that when I start buying Netflix, it was already a powerhouse, and it has already gone up a lot. By the time it's about 300 something per shares, and you can see that way at the beginning when it's founded, you can buy it like $1, $2 per shares. So it has already gone up hundreds of times. And I held it say I'm still holding it to holding on to it. But after 6 years, you can realize that here is 2001, 2002, 2000, about 2003 maybe. You can see that even by 2003, I bought it, and by 2003, about 4 to 5 years in, I'm still losing money on the counter. I'm still losing money on the counter. But if you stretch it long enough, and say even if today they drop, from today's price, drop another 50%, you will see that I'm still on the positive side, even if today crash another 50%. And at the point where it is today, when you stretch it out 6 years, it's still a 20% a year compounded return on this investment, even though it's very, very volatile. So this has been my experience, both in, say, the US market and both in the Hong Kong market as well. Especially when the Hong Kong market hasn't been doing very well over the past few years. You can see that this is another company that I bought in Hong Kong, Xiaomi Corporation. And I bought it right after it IPO, not a few months. When it started dropping, I think it IPO at $18 and went down to like 12, 11. So I was buying it. And for a long time, it didn't move at all. But when you stretch it out, today, it is still close to a 20% a year return just from that moment, right? You could argue that I could have bought here, I sell here, I buy again. But the fact is, we never know. If I go into that game, right, I could have sold here, I could have sold, I could have sold at any point, and I might not bought it back at the bottom. And if I have still been trading this stock, very likely I would not generate a 20% return on that investment. So the key thing here is understanding that action doesn't equal results in the stock market. It doesn't work like this. Yeah. So that's two that I talk about. The third one is a story of uh, this person called Rick Guerin. I hope I pronounce his name correctly. But he is actually the third partner of Warren Buffett and Charlie Munger. So, of course, Warren Buffett and Charlie Munger is the most famous investors there is in our lifetime. And Buffett himself started out investing a few $100s when he was age 11. Till today, he's worth about $160 billion, right? For the past 83 years, he has always been investing and always been staying in the market. So that's how the power of compounding work, and we have all witnessed it in our lifetime. And the interesting thing is, by 1950, 1960s, Buffett, Munger, and also Rick was already successful fund managers. They're very, very successful fund managers, but they're not multi-billionaires like they are now, right? But they are quite well to do, and they're successful, and they have some reputation as fund managers. And the three of them come together in various deal that they saw, right? And one deal that they come together is a company called Blue Stamp, and it's literally a company that's selling stamp, like a discount stamp for retailers. And this is a company that Buffett, Rick, and Munger, together with each of their partnership, bought together into the company to gain control of the company, right? And they partnered together in this deal, and for a long time, they run their own partnership together, but sharing ideas together. And Buffett has said that Rick is as smart as them, equivalently successful. And then the SEC came to audit Buffett and Munger and all the structure, because they're doing a lot of deals together that has become very messy. And when the SEC asked them to clean it up, So they restructure the whole thing, and each of them have their own holding company. And Buffett basically use Berkshire Hathaway as his holding company for everything and move all his investment into Berkshire Hathaway. So when Rick sold his share in Blue Stamps to Berkshire Hathaway, they have a share swap, so he became shareholder of Berkshire Hathaway as well. And then while at the same time he continued to run his partnership. But by the 1970s, when the stock market dropped about 30-40%, you can see here 1973 and 1974, where the stock market has negative return. His own fund together dropped 42% in 1 year and 34% in 1 year. So dropped more than the market, dropped about 70-80% for his whole fund, left 20% of the value because he used something called leverage, right? He was borrowing money to leverage up his investment return because he think that he would continue to outperform the market. But when the market went down, he also suffered, and he suffered so much that he reached a point where he got margin call. Right, the bank forced sell his stocks, and he still owned the banks and the brokerage money. So he was forced to sell his Berkshire Hathaway shares back to Buffett at $40 a share. At $40 a share. If you just Google Berkshire Hathaway share price today, not the, let me just Google it, not the share B, right, where that we typically would invest in, but rather Class A shares, you'll realize that the shares that Rick sold Buffett at $40 a share, that same share is worth $767,000 a share today for the Berkshire Hathaway shares. And that is the key reason why today we heard of Buffett, we heard of Munger, but we never heard of this guy, right? And Buffett has a great quote that basically said that Rick was just as smart as them, but he's just in a hurry to get rich, right? And his advice instead, right, to his advice was, he said, if you are an even slightly above average investor and are able to spend less than they earn, over a lifetime, you cannot get help but to get rich if you are patient. So the stock market is really a place, yes, it's a place for us to build wealth and generate long-term wealth and generate return for our asset. But it will only happen if we are patient, because the compounding works relatively slowly, right? And understand that trying to accelerate that process, especially through using leverage, is a double-edged sword. Yes, you will see boosted return when market is good, but market never stays well and good all the time. And leverage is a double-edged sword. I personally have seen people in my life who has tried to dabble with leverage and it hasn't come out to a good conclusion for them. And it is always come back to the point that they are always too in a hurry to get rich and never think about the consequences and never focus on the downside risk. And this goes back to what I believe, that in life, sometimes we don't have to be first in everything. The main thing is we have to finish and we have to stay alive. And if you are able to see it in a different view, in a different lens, then the way we construct our portfolio might be a little bit different. Instead of focusing on always going for the maximum possible return without regarding the risk, maybe we'll plan it in a way that to ensure that our portfolio and ourselves will stand the test of time. And that's actually more important. So far, I hope you guys are enjoying some of these small snippet stories that I have collated to show a point on some of the key things that I have uh, experienced or come across as in the stock market through different investors. If you have any other um, mistake that you feel that you should be highlighting as well, for the benefit of all of us here as well, I hope you share that, right? It could be your own personal experience, it could be something you observe. I think if you can pull up the chat box and share, it will be very beneficial for all of us as well. Next one is a story of FOMO. Of course, FOMO, as we know it, stands for fear of missing out. It happens in life, it happens in our society when we try to always catch up with the Jonas. We try to match up with our peers, but it also happens in the market when we see other investors chasing something. We cannot help to feel that if we don't go after it, we will be missing out as well. So, this is actually a story of Katie Woods. Katie Woods is now, during COVID time, he was a very famous fund manager. Now, maybe a little bit more infamous, but he started something called ARK Invest. And Katie Wood, going back for a little bit way before she started ARK Invest, Katie Wood is someone who worked very hard and someone who is smart, who worked her way up in Wall Street, right? She was trained and educated as an economist. And then she joined Wall Street as an economist, then later turned analyst, and then become a portfolio manager, and then becoming to one of the top management for a fund house. And then from there, she actually left and co-founded a hedge fund with Lulu Chow, another famous female fund manager that is very well decorated on Wall Street. But she joined that did that for 3 years, and then she left and then joined a firm called Alliance Bernstein as the CIO, Chief Investment Officer. And she was in that position for 12 years. Right, so she was the chief investment officer for this fund house, and for a long time, she has a good paying job, and she was well respected on the street. Then she wanted to start something, a new idea that she had. She had a new idea, which is she wanted to start an actively managed ETF. So now ETF has been growing for a very, very long time, especially in the US, where today the ETF market is in trillions of dollars, almost as big as the unit trust and mutual funds fund industry. But the ETF is famous for something, which is they're famous for low cost passive fund. So the difference is passive funds are basically funds that don't really need a fund manager, where in fact the fund is just tracking an index. Say for example, the US has the S&P 500 ETF, S&P 500 index, and the S&P 500 index is basically something that is just mirroring the index. So they don't really need a fund manager to make any decision. They are merely just copying whatever the index represent. They'll buy that stock and just track that index. And in the last, especially during COVID time, they started to have more and more interest coming up with actively managed ETF. So these will be ETF funds that has a fund manager, and the fund manager will be responsible in having the strategy to pick the stocks and in hope that they will generate even higher return compared to what the index is giving you. Right? It's a great idea, and I do believe in this idea, right? But it also depends on the manager, lah, right? Um, so she started ARK Invest during 2015 before COVID. She left the firm at 2014 and then started ARK Invest in 2015, right? Just started small and then slowly uh, it generated more and more interest. And it in 2017, it was deemed the best performing fund for that year. You can see that it really came into spotlight during COVID period, where 2020, they have one of their best year, a return of 149% a year. So they are the best performing fund for that year, and which is also the time where almost everybody would have heard of ARK Invest and ARK ETF, right? Where people who might not really invest in ETF would also have heard of it. But it also lead to the next few years of underperformance. Right? In 2021, 2022, it really crashed down. And a lot of people actually bought in 2020. Um, and her main strategy is always focusing on the idea of finding great disruptor uh, company that could potentially become the next Tesla and the whole 9 yards. So her whole strategy is to trying to attract investor who liked the riskiest investment and all the investment that is more popular, more in vogue. And yet, over the last 10 years, that strategy of always chasing after the most popular stock has gained her about 122% return, right? So still pretty okay. So over the past 10 years, she more slightly doubled the money. But versus the same period, the market has actually went up 330%. So just a boring strategy of just following the market, regardless of what's in vogue or what's not popular or what's popular to invest in, not caring anything, compared to a strategy that's always chasing after the next hot thing, it's quite clear that the stable and boring actually generate higher return. And this is kind of proven true with this one example. So I believe that for an average investor, like especially if we are retail investor who are just managing our own, or you're working with someone to just plan your investment, it might be better to just take the middle ground, right? Always trying to find the middle path rather than chasing after the hottest thing right now or chasing after what other people are chasing after. And if we have a proper process and proper viewpoint and philosophy that what we are creating should be agnostic to what the current market is trying to promote. And in the longer term, we could more potentially come out on top. Let me know so far if you agree or disagree with some of these mistakes that I have highlighted uh, on the chat box, or if you have anything to add as well, right? And the last one I wanted to talk about before we end the session is the idea of selling winners and holding losers. This is something I see over and over and over again, of selling winners and keeping losers. When in fact, I remembered maybe when I was investing for myself and also quite actively on the online space of talking about investment. After a few years, a relative actually came to me to ask for some opinion that she has her CDS account and there are a lot of stocks inside and she don't know what to do with it. And so when I look through the portfolio, I realized that every single stock that she has is losing money. So I went to inquire and ask her, like, how come all the stocks that you have bought are all losing money? And then why are you keeping them? And then basically, her reasoning is quite simple because all those that she has made money, she have sold them off. And these are the ones that is underwater and she don't want to sell them because she don't want to realize the loss. And whatever is inside is just paper loss, right? Have you heard that term? It's only paper loss and I don't want to sell it. And all those that has increased in value, 10%, 20%, she has sold them off, and that those are real returns. These are not real losses, right? I believe this is a lie that we tell ourselves, and it's a lie that we continue to tell ourselves over and over again, and that's why every time when we see when we especially talk to our if you have a chance to talk to investing about with your friends or everything, when we talk about a return that they get from the investment, everybody seems to have a higher quite a very high number of on a percentage return that they feel that they're generating, right? That's because in our mind we are only counting our winners, because the losers, they're not actual loss, right? They're just paper loss. So we don't count them first, and we count the winners. And so everybody seems to have fantastic uh, returns. And I think it will be good if we be honest with ourselves, even if it's on paper, it's still a loss because it is almost impossible for many of that stock to ever recover. And the longer that you hold on to it, uh, it would actually be more detriment. And this is something that we try to protect ourselves against because of something that is cognitive bias in ourself, in all of human, which is called loss aversion, which is that we feel the pain of losing something that we once have is more painful than any gains that we get, right? This is a picture of me, but similar to me, where this is something that I feel as well, right? I'm starting to lose my hair, and this is something that I once have, a beautiful set of hair, and this is something that I cannot let go. Right? It's similar to the stock market, that when we see something that we once have, now we don't have, loss aversion sets in, and it's very painful for us to see it in objective light. But we must see it in objective light, because if we don't sold off these stocks, we are losing a lot of what we call opportunity cost. These stock can be sold out and buy into more higher potential funds or stock that is, free up our capital to make that decision again into better decision, into better funds and stocks. But if we keep on to it, it's already a loser and we have made a mistake on it. If we hold on to it, we will continue to suffer the mistake. And this is something that I learned to switch that mental block by really studying the portfolio of Warren Buffett. Right, this is the current portfolio of Warren Buffett. Right, of all some of the key stock that he owns, that you can see here, is actually published online. So if you just search Warren Buffett portfolio, a lot of news site actually publish it. This is a screenshot from CNBC, and you can see that if you it don't show it here, but I have another part where it shows his cost and his total return, you can see that almost all his stock would be in the green. Almost all his stock he's making a profit in. Does that mean that Warren Buffett never make a mistake? Right? Does that mean he's such a great stock picker that he always buy the correct stock? That's not really the case. He has made a lot of mistake before. He buys the airline stock and he lost a ton of money. He bought into Tesco, a retailer. He lost a lot of money in that. He has bought many stocks that he lost billions of dollars in. But it's not showing here why. Because his whole strategy is completely different from the rest of us. He doesn't sell his winners and then hold his losers. He do the opposite thing. He actually sell his losers and keep his winners. And it goes back to our actually first point, where because he always buy very high quality companies that has the potential to compound for decades and decades, when he buy it, he will hold on to it and let it grow. Let the business grow, let the stock grow over time. And he has compounded over and over decades, right? Coca-Cola he's owned for like 30 years. American Express he has also owned for 20, 30 years. So these are companies that he bought for such a long time and just hold on to it. Whereas a losers, where he owned for a few years and then he realized that he made a mistake, he will cut it off and use that money to buy better companies. And that is the key reason why he's able to compound his money and why many of us is unable to compound our money, because we are holding on to stocks and funds that are not compounding at all because it has been a mistake. And we need to see it as such, that we have made a mistake. It's time to move on and learn from Warren Buffett. And how I start to embrace this idea and how I start to incorporate that strategy into my portfolio. I have also seen very good results with it. And how I do it is I stop tracking my buy price. Meaning that if I buy a fund, if I buy a stock today, I don't remember, I don't write down, I don't track what price I bought it at. So I do not know what price I buy something at. But what I track is my entire portfolio performance. So if I have invested this amount of money, I know this is my capital that I've invested. If I add any money along the way, I know how much money I put into the portfolio as my capital. And that is the number I track. Has my whole portfolio grown from that number? And that is the only number that I care about. So every time I need to rebalance my portfolio, every time I need to sell something and change something, I don't look at the fact where am I losing money in this stock or am I earning money from this stock, right? Then I never put that into consideration. I see it as, now I have this fund. Where is the best opportunity I can find for this amount of money? That's it. So it goes back to a lot of my philosophy, where the key is really focus on long term, not chasing after the market, focusing on risk management. So in terms to build an everlasting portfolio. And that has allowed me to grow my portfolio um, more than 5, 6 times over the course of the last 10, 15 years. Yep. So if you guys have any question, do let me know. Something you want to discuss, do let me know. And this is also something that I try to have a discussion with my clients and working with them to see how they view their investment, how they view money, right? What is the psychology of money, how they view money, what's their relationship with money and investment, and then working out with them on their current situation and simulating goals and scenario on how we can best plan out the kind of investment that will help them reach these goals. And I'm attached to iFast Global Market in the JB office. And of course, I serve clients all around Malaysia as well. So if you do want to speak with me one on one, you can always find me from learnwithstanley.com or uh, fill in the Google Sheet form here, and I'll reach out to you as well. Before we go, as usual, I tend to have a segment called Spin Off. So this is a part where I'll share a little bit in just something off topic that I find interesting that I want to share with you guys. And this is a book by Dan Ariely called Predictably Irrational. And I think this book fits nicely with what we talk about today, which talk about a lot of our major cognitive bias about how our mind works, how we make decisions, and how actually everything is linked to emotion of how we think of things. And I think that learning more about behavioral economics, learning more about behavioral psychology would be more profitable for us as investor than any investment book that we can find. And learning about just psychology and behavioral finance has really allowed me to understand better how the market works. And that has been wildly profitable. So at the end of the day, I'll leave you guys with this quote, which is always think about that we cannot control the result, but what we can control is only the process. So, what we want to plan and focus on is really focusing on creating the right process for us. What will be in the future uh, will will eventually happen, and all we can control is the process. Thank you so much all for joining me tonight, and I hope you guys enjoy the session. If you have any other question for me, you can always email me. You can find my information at learnwithstanley.com. And I hope to hear from you guys in the future. Till we meet again, my name is Stanley. Invest safely, guys.